welcome to the film. On the show this week, what promoters want to meet the 25% challenge and the growing clout of US antitrust law. By June 2013, promoters of all listed companies in this country have to reduce their stakes to 75%. Now, by various counts, at least 200 companies, including several government-owned ones, are far away from meeting the 25% minimum public shareholding mandate. The challenge is threefold. Time is short, but SEBI seems to be in no mood to relent, and unless the government changes its mind, June 2013 is a hard limit. The second challenge is the market environment, and nobody can fix that. And the third issue is the lack of suitable dilution methods. Companies, their lawyers and bankers complain that by restricting the dilution routes to three acronyms, FPO, OFS and IPP, SEBI is being too prescriptive and too restrictive. Well, SEBI Chairman UK Sinha told me this in response.
People who are raising these issues, they do not have their heart on diluting. I'm leveling this allegation that if there are so many options available, why can't you as a promoter reduce by 1%? Show me your intention. Why is that intention not being shown? Yeah, just imagine there are 30 companies who are less than 10%. And this rule has been in place since 2001. In last 11 years, you didn't find any opportunity to dilute, and you are as low as 2%. How will you reach 25%? Please show your intent. Don't expect everything from SEBI. I'm giving an assurance that we are willing, but where is the action from your side? Please do that. You will find us very, very responsive. If I find that companies are very keen and they are serious about diluting their stake, then the manner in which they can divest or not divest, that will not come in the way. We are looking at this entire thing in a fresh manner. Just because the avenues are limited, that will not come in the way. We will provide them all the legitimate avenues.
That's UK Sinha throwing the gauntlet back at India Inc., its lawyers and bankers. So what are the additional avenues that companies want in order to meet the 25% challenge? Well, joining me with their lists are Sanjay Sharma of Deutsche Bank, Somashekar Sundaresan of JSA and Manan Lahoti of Luthra. Gentlemen, to all three of you, a warm welcome. Sanjay, tell me why these three routes that SEBI has prescribed are not enough. Because if you look at it, the OFS is a lot like the block deal, except that you're selling to a wider set of investors and there's no scope for negotiation or negotiated deals, which is exactly what SEBI wanted. The IPP is like QIP, except that the minimum number of investors has to be 10, not 2 or 5, and that meets SEBI's criteria of broad-basing shareholding. And the third option, the follow-on offer, has existed right from the time that this notification came into force. So why are these three routes not enough?
First of all, I'm not saying that there are any shortcomings in these three routes.
No, why are they not enough?
I think they're not enough because, like any product, each product has its pros and cons, and there are limitations. And superimpose on that the two conditions which you mentioned in terms of lack of time and the market being challenging.
The lack of time is not SEBI or the government's fault. Yeah, companies have pushed it to this point.
I'm looking at it from now on. If you're looking at from now on, yes, there is about 1 year left, and the market is not.
But if you looked at it in February 2013 or March or April 2013, no route would be good enough, right?
Fair point. So that's what I'm saying. It's not that these three are not enough or there are any shortcomings.
Okay.
Couple of points on, because of the market being such, FPOs make sense only for large issuance of, say, $100 million plus, because it entails that much of effort. IPP, as you mentioned, the limitation of 10 investors, at sometimes for smaller issues may be a constraint.
Okay.
But otherwise, broadly speaking, these three are not, that they are not sufficient.
So if I can open this up and also argue the point that FPO in this market condition, you're saying would work only for a certain size of issue, in terms of the time, the cost and all of that. But as Mr. Sinha has pointed out, there are several companies where the public shareholding is 10.
Yes.
So for them it would make sense to do a follow-up offer, wouldn't it?
So if you look at some numbers, there are at least top 10 companies would raise about $4 billion to get this to.
Right, so for them a follow-on offer would not work?
For them, follow-on offer works in terms of size.
Yeah.
But in a follow-on offer, there is a time limit which, from the time you finalize the price till listing, is still about 3 to 4 weeks. and given the current volatile markets,
it wouldn't work.
It wouldn't work.
Okay,
so that's why I say OFS came in.
Yeah, and the other point you raised about IPP being only 10 being 10 investors, minimum 10 investors, and that could be restrictive. But the whole purpose of this exercise is to broad-base shareholders. So if you have a problem with finding 10 investors, then you have a problem with the whole spirit of this exercise, don't you?
You also need to look at the type of companies which are there right now, which are non-compliant. These are companies which, by the mere logic, are not very liquid, do not have too much of institutional holding, have less of research coverage. In that context, to try and sell it to a broad base, it becomes challenging.
So what do we need to add to the list then?
I think you don't need to be fixated on a list. You need to focus on the quality of public shareholding rather than the quantity of public shareholding.
Right.
These statistics that we are looking at also has compliant companies where an LIC or a GIC may hold 14 to 15% for decades on end, never traded.
And you think that doesn't meet the spirit of
exactly.
broad-based?
The spirit of requiring a minimum public shareholding is you need to have enough float which enables you to have a high quality price discovery in the secondary market. That's the intent of having a minimum public shareholding. You can draw the line anywhere, 25, 10, 15, 30 as you will.
It's been drawn at 25.
It's drawn at 25.
It's drawn at 25.
But the policy focus needs to focus on the quality of public shareholding rather than the quantity. And you can't treat a company with public shareholding of 20% on the same terms as a company with public shareholding of less than 10%. Those three routes can't be applied to a company which has to divest 2% and to a company which has to divest 15%. You can't apply the same three routes and say these are the only three routes. Let me give an example. The Indian Constitution actually, before I give an example, says something that's not prohibited is permitted. Reasonable restrictions by law can be imposed. So if you want to impose a restriction by law, you need to have a good reason to impose that restriction. So if you're talking about what is good policy, I see no reason where, say for example, a promoter owns some shares, he has every right to sell them in the market. So
but the problem, as you will note in SEBI's own board meeting notes that SEBI has raised, is that block deals nowadays have been noted not to be the standard anonymous trades that they're meant to be, but instead negotiated off exchange and then carried out on exchange, and they have a fundamental issue with that. That doesn't meet their transparency criteria. They've laid out two criteria on the basis of which this entire exercise of dilution or sell down needs to happen: broad basing of share ownership and transparency. The block deal doesn't meet transparency.
The best of objectives cannot justify the worst of policies. Assume you do an OFS or an IPP, you do one of the three methods. Are you then going to regulate who can buy those shares?
No, but
in what quantity?
Those processes are designed to reach out to a larger number of investors.
So that's a misplaced design.
Like an IPP, you have to have minimum.
Let me complete, Minka. It's a misplaced focus on a design. Because you're saying, I will allow one of three designs to reach it because I think these are laudable. Come closing date, there's no other restriction in law or in fact, people are going to be able to trade. So you're not going to say, I'm not going to let anyone buy more than X% of shares. That's a rationing mindset from which it's come. I think we're writing regulation just because we have the power to write regulation. If someone holds 75% or 76%, what's the harm if he sells in the anonymous screen-based trading system? If you don't want block deals,
because it's not anonymous, it is increasingly
if you don't want block deals, ban block deals.
I agree with the qualitative concept of broad basing which he's talked about. Broad basing cannot be looked at from a perspective that you need 10 investors. Let's take an example.
That's the beginning. They're not
let's take an example.
That, right?
There is a company with 85% holding, gives 5% to one domestic mutual fund. Isn't it broad basing? Mutual fund on the back of it has hundreds of investors. What we are saying is don't give preferential allotment to a promoter entity or an individual, but at least to QIBs.
Okay, so let's create a negative list. If not a positive list, let's create a negative list. Maybe preferential allotments is out of the list, right?
Yeah, sure. Maybe.
Let's create a negative list. Maybe that's more useful.
But why should even a preferential allotment shouldn't be banned? There is a QIB route in the ICDR.
Yeah.
A private placement of new shares to qualified institutional buyers.
The QIP.
Yeah, that's right. So when you wrote the QIP law, you wrote a provision saying to be eligible to do a QIP,
right,
you ought to be compliant with listing requirements. You wrote that law.
Yeah.
It's subordinate law. You have every right to say a QIP shall be a valid means to achieve minimum public shareholding. What's the logical rationale to
Because
not
the
recognize
QIP,
it as a
from what
method?
I understand, requires only a minimum of 2 or 5 investors based on the size of the issue, whereas they want to broad base, which is why they've ignored
which is
QIP
my problem.
and created an offshoot of QIP,
Yeah,
which is the IPP,
it's
which
a bit
is
of an
minimum 10.
existential argument. That is exactly my
So
problem.
whether you create a positive list or a negative list, the need of the hour is to suggest to SEBI more avenues via which promoters can sell down
Open it up.
to everybody.
Just open it up to
everything.
everybody. If there's something that you feel is market abuse, you have the FUTP regulations to act for. If something you believe is undesirable, prohibit that.
No,
Let the
but
rest be
it's not
allowed.
market abuse. See, if you do a preferential allotment, let's say, to 1 or 2 investors.
If, as Sanjay says, if that's UTR, let's say it's LIC.
No, if it's LIC,
Let's take
it's
the
fine.
favorite
But what if
public
it's not
shareholder?
LIC and it's a private equity fund?
Let's take the
That's not widely
let's
held.
take the-
In which
why
case, it
not?
doesn't meet your broad basing criteria.
What
They
if
laid out their philosophy.
what if it's a private sector mutual fund?
No,
Is that
mutual
okay?
fund
Is that
is
not
okay.
okay?
Yeah.
So if it's
something, create a negative list or
if
create
it's
a positive list.
QIB, which you recognize as a QIB under your securities law of the country, it shouldn't matter whether you give it to 1 or 2 or 10.
Okay, Manan, you're very silent in all of this.
Right.
A negative list, positive list, what do you want? And can you tell me what new routes need to be added to the existing ones so that promoters stop complaining about not being able to meet this
So
deadline?
just to quickly react to, I think, the point that both Som and Sanjay was talking about. See, quality is a very important criteria, but it's more subjective. I think the regulator's taken a view here that probably quantity is is going to take care of the quality aspects.
Sure.
So long as there is a reasonable threshold, and
Okay.
for them it's 25%.
Yeah.
So and I think it's slightly easier to monitor over a period of time, and I think globally this is how it is done.
Right. So
We
you're
draw a line somewhere.
broadly in agreement with what
If that is the policy, I think yes, we probably the next step really here to think about is what are the possible ways.
Let's go
which
through those.
SEBI hasn't thought, probably already has thought about, but maybe they can still think a little
Yeah,
bit
so
more
let's
about.
go through those.
So for example, they obviously allow IPP, which is like you said, an offshoot of QIP. One other additional route they can think about is a modified rights issue,
Okay.
which broadly means that rights issue has to be given by company to every single shareholder. But if promoters don't participate, they could be essentially diluted.
So
through
they
that route.
renounce their rights and let their rights lapse.
Well, the
So they don't
question
renounce
is-
in favor of somebody else.
You
They
could have
renounce.
sort of 4 formulations here. In the first formulation, you could have promoter cannot renounce, for example. Because the moment they renounce, the question is who's going to come in, and whether it will be renounced in favor of one or it's going to be renounced in favor
Right.
of many. The second formulation that you could do is that, so the first formulation is promoter does not participate at all and does not have a right to renounce either.
Right, and that seems to be the most ideal one, right? Because then he can't give them up in favor of friends and family, so to speak.
Yes, actually, in a way, yes. But I think so you probably would have some challenges about minimum subscription amount. Because typically for rights issue, you still need to get 90% buyers. We're talking about situations where maybe 80% is held by the promoter. So you're expecting at least, actually you're expecting 20% public shareholders to buy 100% of the rights issue. Which, I mean, I'm sure Sanjay probably will have a view on that.
So not everybody will be able to use the rights issue, but some of
That's
them
right.
could.
Probably yes, yes.
Depending on, so
Sure.
horses for horses, right?
Or you could even think of
Horses
maybe
for
having some underwriting element there. Or maybe you could think of bringing down the minimum subscription requirement.
So
for
rights,
issues.
a modified rights issue is one
Yes,
route.
yes.
What else do you have on your list that you think SEBI should consider?
Maybe ESOPs, maybe ESPS more than ESOPs, because you don't have so much time now to do ESOPs unless until you were to allow ESOPs through a welfare trust route. So typically in that situation, what you would do is you would allot all the shares to the trust straight away. And trust would give out those options and shares over a period of time.
Okay.
But what you would end up doing in the next 1 year is just parking those shares with the trust, which may not be a great idea. So what you could think of doing is ESPS, which is you give out shares straight away to employees without, giving out options first and then the shares.
Okay, that's
So,
one.
yes,
I
so
think
ESPS
several people have mentioned a selective bonus or
Yes.
a bonus in which the promoter does not participate.
Right.
Is that something that would be amenable?
So sure, companies who have capital reserves and who are thinking of, giving out bonuses as one of the possible route, they can choose. They can have an article in their article saying that, if a shareholder does not want to take shares under bonus, they may write to the company.
Right.
So that's the way you could think of doing a selective bonus issue as well.
Okay. Sanjay, you want to add to that list?
No, this is fine. The only challenge would be if you look at a modified rights issue, and as Manan mentioned, we're talking of companies where promoters own 75% or more.
And how do you get 25%?
How do you get that
right?
balance 75% subscribed? So that's
Right.
one challenge.
Right.
But looking at two, one is a modification of the current IPP guidelines. Just for example, if there is a company which has to do only $20 million worth of selling for meeting the requirement,
Right.
as per IPP, if he wants to do the IPP route, he can only do 20.
Right.
Now, why not allow the same process to be used for somebody who can raise 100 million, 20 to meet that requirement, and the balance 80 is used for the company's operations. A company wants money in the company to run the business.
Right.
You are constrained by using IPP route to come down to 75, and then after a gap,
I thought the IPP guidelines allowed for
only up to 75. If you want to go below 75, so suppose from 76, I want to come down to 60, I can't use IPP. You need to first come from 76 to 75,
right,
and then do another offering.
Okay.
So that's one thing. The second is, if you look at in today's scenario, a lot of companies have the promoter shareholding pledged to some of the financiers. Now, if there is a trigger, market trigger, which basically triggers the pledgee, the NBFC or the bank to sell those shares, that is not eligible because it does not form a part of one of these three.
But wouldn't that only apply to a very few number of companies really in the non-compliant list?
Actually, what Sanjay is raising a very important point. You need to, I would modify it slightly and put it differently. It's not even a method to achieve compliance. It's the evolution of facts that will mean you are compliant. I ask myself, if there is a company with promoter shareholding that's 77%, lenders invoke the pledge and sell 5%, the promoter stake has come down to 72.
But he's not compliant.
I want to see SEBI issue a show cause notice to say,
you are
not compliant. Although you are at 72,
listen, I don't
because you came down to 75 in a route other than those three
I don't
routes.
think they're trying to be unreasonable.
Right,
I think
exactly. So if they can't act in that case, they shouldn't be able to act in any case where someone comes to below 75 in a legitimate manner. The chairman used the word, we are open to looking at any legitimate manner. A legitimate manner is, I own a property, I have a right to sell that property. That's legitimate.
Okay, so I'm not going to get a list from you very clearly. I'm going to give up because we're almost at the end of our time. I've got only a few seconds to go.
Need a list.
If these additional routes are put on the table, are we likely to see higher compliance by those 200 to 50 companies that have yet to meet that 25% norm? Sanjay?
I wouldn't say a clear yes. I guess if, as chairman himself mentioned, if somebody wants to really comply with the regulations, most of the companies will be able to comply with these three guidelines.
Okay.
I think the point is, on a case-to-case basis, if Som's suggestion of blanket is not acceptable, which I think has its own merits, on a case-to-case basis, there should be allowance that if it is legitimate, if it is sold out to investors, whether 2 or 5, I don't think that's number should be what people should look at, but what type of investor the share has gone to.
Okay, Manan, last word to you on this discussion.
I think, just sort of discussing that point about someone being just slightly higher than 75%, I think we probably need to be more sympathetic towards the promoter. Maybe doing an OFS, maybe doing an IPP, maybe doing an FPO is really not for him.
Yeah, sure.
So for those cases, some of those cases at least, double down should be allowed in the market itself.
So sell on the secondary market is what you're saying,
yes,
right?
That's right.
All right, let's hope the regulator is listening. He's promised that he is. So, gentlemen, I hope he buys all your points, including Som. Thank you very much, Som, Sanjay and Manan, for joining us. We need to take a quick break. On the other side, the growing cloud of US antitrust law.